Elon Musk wants the Fed to cut interest rates immediately, but the Fed says inflation is still too high. I'm going to talk about the 3 sectors for financial safety as costs keep soaring. Now, it's hard to say how effective the Fed's tightening monetary policy has been at controlling inflation, but one thing is for sure. Higher borrowing costs do not bode well for the economy at large. Now, not surprisingly, experts, including Twitter owner Elon Musk, are now calling for rate cuts. But even the richest guy in the world doesn't always get what he wants. Federal Reserve Chairman Jerome Powell has said that inflation remains way too high. As investors, we look for safe havens to ride out the financial storm. And here are the 3 sectors to invest in while the rates are still in flux. Number 1, consumer staples. High interest rates cool down economies when things are running hot. But when the economy is not running too hot, there's fear that more rate hikes are coming. That's going to lead to a recession. And that's where we're at right now. That's why investors flock to recession-proof sectors like consumer staples. Now, a consumer staple is everyday essentials like food, water, beverages, home goods, hygiene products, things like that. Things that we need to basically live. Now, regardless how the economy is doing, people need these items. They may go up in price, but companies produce these items, they pass all those higher costs to the consumers, and investors get to capitalize on that when they invest in those companies. Number 2, banks and lenders. Now, businesses generally don't like rising interest rates, but for businesses like banks, higher interest rates are a good thing. That's because banks lend money at a higher interest rate than they borrow it at, and they keep the spread, they keep the difference. So when interest rates increase, the gap between how much the bank earns typically widens. Now, big banks like Chase and Bank of America are very well capitalized right now, and they've been returning money back to their shareholders. Number 3, real estate. When the Fed raises interest rates, mortgage rates tend to go up as well. You would think that this would be bad for the real estate market. In actuality, real estate has demonstrated its resilience in times of rising interest rates and historically has outperformed equities and bonds. Smart investors know that real estate is a hedge against inflation. This is because the price of raw materials and labor keeps going up, and new properties are more expensive to build. But that also drives up the price of existing real estate too. So well-chosen properties can provide more than just price appreciation. Investors get to earn steady streams of income on rental properties while they wait for the appreciation to kick in. You don't need to be a landlord to invest in real estate. My team and I help people like you invest in deals, and we coach people on how to get in deals of your own. If you want to know more, click the link in the description and let's set a time to talk. Be bulletproof, guys. Talk to you soon.